But beyond that, I just don't see any value in this business. And other than an acquisition arbitrage opportunity, like I would kind of steer clear personally.
I kind of feel like gaming is following some recent bubbles that we've seen in at least Canadian exchanges. We saw it in cannabis.
It would just be uneducated for me to even consider making some kind of investment into this without first becoming a bit of a gambling degenerate, and then maybe we'll be back. Who knows?
You invest in penny stocks, don't you?
What's up, everybody? Welcome back. This is episode 8 of the Beyond the Edge podcast. This week, we continue our quest for growth stocks, quality growth stocks under a $10 billion market cap. I've got Pete Pilarchio, resident trend tracker, Declan O'Flaherty, Mr. Fundamentals, keeping us laser focused on the financials. I myself and Kev Matheson, aka Small Cap Kev. If you guys don't know, we record every Thursday, drop an episode every Sunday. Make sure you follow along. This week, we got a lot for you. We're going to start this off with a failed acquisition attempt by Amazon, trying to buy iRobot. Then we're moving on to Bragg Gaming, signing a distribution deal for a bunch of their online casino games, finishing with a very, very, very large $30 billion bid for Paramount Global from Byron Allen. So, boys, we have much to discuss. We're going to jump right into Amazon and iRobot. Now, I'm familiar with these Roombas. They've cruise around your house, they bump into things in the night, scare your cat, and occasionally get stuck and have to be retrieved before continuing on their programmed journey. Never owned one myself, though they do seem interesting. Lots to talk about the company, however. Pete, I'm just kind of curious, do you have any views on this company? What does this look like from a trend perspective? What are your overall views on these guys?
Yeah, I mean, from a trend tracker perspective, if your mortgage cost just went up by 40%, are you dropping $1,700 on a robot vacuum? Probably not, and no one else is either, guys. Sales are going absolutely the wrong way. They just had a brutal quarter. I do not think this was a regular issue. I think Amazon's using that as a complete scapegoat. This deal got repriced 6 months ago, and I think they just saw where the stock is at today and the way things are going, and they said, here's 94 million bucks, we're out. Whether they come back in, I don't know, that remains to be seen. I'm looking forward to this discussion actually on this topic of where it's priced at now, but the head of the EU competition committee, Margaret Vestager, she flat out said that, our job is to put out the problems, and Amazon's job is to kind of come back and remedy those or debunk them or come back with a plan. And I think she was left on red. So Declan, what do you think?
Yeah, so I really second that, Pete. I think overall, Amazon is probably really grateful that this deal didn't go through, and they should be thanking the EU for it not happening. I mean, our iRobot has kind of been a fledgling robotics company, surviving on a legacy product that was first introduced in 2002. And, for many of us, the Roomba was probably our first introduction to household robotics, but they haven't really been able to do anything beyond that for the most part. And kind of like you said, I think when interpreting the deal when it first came out back in 2022 was that Amazon was really looking to acquire it for its proprietary technology, whether that's its expertise in navigating and mapping systems or just the AI software in general. But over time, as things have developed, I think it's been quite clear to Amazon that they could probably do this on their own and didn't need to acquire a subsidiary in order to integrate that IP back into the business. But beyond that, what I really think this is a bigger reflection of is the robotics industry in general. And when you think about it, a lot of these highly touted companies, whether it's Tesla's autonomous driving or the Optimus robot or even Apple's autonomous driving and the like, these companies have really struggled to, I think, reach their ultimate goal of building autonomous robotics that can kind of operate without human oversight. And where I think this extends to is that it's less of a hardware problem and more of a software problem. You see, the thing is with these robotics that are trained on machine learning models is that they struggle to learn in real time. They fail to take in context, and they can't really cooperate with other robots outside of their own domain. And so for these reasons, they've had a real difficult time of really integrating them into the real world. And so whether they continue on this path or not, what these businesses are realizing is that there may not be a long-term solution that, at least in their current trajectory, they are going to be able to overcome and solve these issues. Now, interesting enough, this is where something like maybe versus AI and active inference could come into play. But overall, when it comes to this deal and the future of robotics, I think there's a lot of issues that need to be addressed before anyone really breaks through and builds the type of devices that we think and we see all the time in these sci-fi fantasies.
Well, these certainly aren't something of sci-fi fantasies. You know, a little robot that bumps into your furniture as it cruises around your house scaring your animals. You know, I see a business where I would say there's a lot of value in the name Roomba. I think most people will be familiar with that. The company name iRobot, I don't think holds as much of an intangible value as that one product. And what I can't help but see is a company that I feel like almost lost its way, where they created a hit product where, let's be honest, the Roomba was absolutely a hit product. It redefined an industry. Maybe that's a little bit too much praise for them, but it really defined a product that I think a lot of people didn't know could exist. And they really lost their scope from creating these robotic vacuums to, let me just read part of their about section. They design, build, they sell robots and home innovation products. They offer floor care products, families of automatic floor mopping robots, accessories, consumables, handheld vacuum, portable vacuum, air purifier, root robots to help children learn how to code, create. You get my point.
It's
right?
Yeah, 100%. When I look at the history of this business, they had a really cool product, basically owned the entire market, and saw kind of growth as more people saw these things. They weren't seeing a lot of growth even in 2021 in North America, but Europe, Middle East, and Africa, they were seeing substantial growth, as well as, Asia. So that was great. And they somehow in their investor deck addressed this as a $16 billion industry, and then started looking at product diversification. And in their product diversification of where they see their market opportunity, I'm not kidding, lawnmower is on there. I don't know what they were thinking. They have smart speakers, smart plugs, smart thermostats, and then home security, smart door locks. These guys thought they were going to take over the world, I guess. And likely, with the success that they had during kind of the e-com boom of 2021, invested in all of these things, because as soon as this deal, the plug got pulled, they laid off 30% of their staff, which I'm assuming a lot of these projects are getting cut, and rightfully so, because I was also completely shocked to kind of see the children's learning they had on the vacuum website. I don't know who spearheaded that. I hope they're part of the 30% guys. It's called the computer. They're gone. Sorry.
That was the first to go.
You got to be gone. Yeah. I mean, so that brings me to the point, now that, they may have got excited with the profits they were making in 2021, probably got very excited with Amazon purchasing them at that $61 a share mark, probably launched some things. They had to take on $200 million of debt to keep the lights on. Yeah. And then that's when this deal got repriced 6 months ago. And then I think they just kind of kept going the wrong way. So completely misread the market. But if they right size and go back to their core product, and they're still doing $200 million a quarter in revenue, are they actually undervalued?
There's something there. I mean, there's certainly value in what they've built. Something that I was curious about. So one of the key reasons the regulators didn't bless this acquisition is because they said it would give Amazon the ability to basically favor their own products at the expense of everybody else listed on Amazon. So I just did a quick little search for, what did I type? Robot vacuums on Amazon. And there are so many of them now. And the Roombas aren't even at the top. So they currently don't have a top position on Amazon as it is. And the pricing competition, I think almost, the majority of the vacuums that I saw on there were being heavily discounted. So I think you're in a space where it's getting more and more competitive, that I think that almost needed to go to a strategic buyer, because I know you guys were saying maybe Amazon breathed a sigh of relief, paid the $94 million breakup fee, and was like, thank goodness, I'm glad that I'm not part of that. I don't know if I totally agree, because when you think about a strategic acquirer, there's always I'll call them synergies or growth opportunities you may not think about. And one thing I thought about this, think about the core technology of Roomba, of the ability to scan your room, understand what kind of space you're living in. It knows where you're living by easily have a GPS in there, or when you log in and select your location. It could also know what Bluetooth devices in your house. It could connect with Alexa. I think I could just see a lot of intelligence gathering that Amazon would probably be drooling over. Now, maybe I'm just being paranoid and thinking too far into this, but I don't know. With a strategic like that, I can't help but believe there was a lot more on the table than just the technology.
Just like on that note, Kev, I think that brings up kind of a point about the technology itself, and this is perhaps like why I do see somebody like Amazon almost being grateful that this deal didn't come through. Is I agree, yes, the data is important, and I think for a long time, iRobot and through the Roomba had kind of established how you could have smart devices in a home beyond just say like the speaking Alexas and the Google Talk and all these things. But this is where the problem I see it being is that if these models continue to operate using neural networks and machine learning, they're going to continue, like there's not much differentiation. And so yeah, they've collected a lot of data, but I think if you want something that's let's say it's in the cleaning field, you want an all-purpose robot that can just clean your house all the time. It takes care of all the main chores, anything that you don't want to do. Where they're going to run into issues is that these robots fail to understand their context very well and also look at the bigger picture. Something like a Roomba. Roomba has a very specific design. It is set to follow this input that it has been given and ultimately stick to that, but can never really adapt beyond that. And that's where, again, all these products, say robotic vacuums have come into the market. There's not much differentiation. And I can't see something like even Roomba, despite maybe the brand being that much valuable or that much more valuable beyond what it already is. So I think that's kind of to your point, where the data is important and they have a lot of it as well as the brand, but how is this technology really going to evolve in the next little while? I don't really see them being able to differentiate from that standpoint.
Did we say lawnmower?
Don't think it was yeah, we said lawnmower because Declan, you said some really, I think, bright things about robotics in the future there, and that there might be some value in the technology that they have. That was nowhere to be found in their pipeline of growth. So one of the first things when I kind of looked at this, when you guys brought it up as a topic to talk about today, I dove right in. First thing I thought, customer lifetime value, and what is it, right? There's no servicing on these things, so they needed some product diversification or really great unit economics and then just overall kind of growth of the market. Now, they did actually have in their pipeline what Kev brought up, which was connected devices, that they thought that that's how they get people on more of a subscription fee. And I think maybe it fit into kind of the Amazon wheelhouse that way, because in their kind of pipeline, when they say thermostats, well, Amazon already has that with Ecobee, and it already has an Alexa integration. They have home security. Well, Amazon got into that a long time ago, right? So they definitely saw maybe that opportunity of some type of monthly subscription model. It was in, a recent investor presentation of part of their pipeline of how they thought they could expand their customer lifetime value. But did they miss the mark on it? Absolutely. And I think, the time to look at investing in that and hitting it has come and gone. That's not happening. So I don't know if they don't get back to basics of selling really good robotic vacuums. I don't think it looks bright in the near term future. And I'm sure they have some reevaluation to do internally on how they're going to respond to shareholders of what their plan is.
Well, we saw an announcement recently, and I'm looking here at the chart, and it is not a great looking chart. And one thing I'll say is I think we can all agree, even if Amazon, whether they wanted it or not, 1.7 billion probably wasn't the right price. That was probably grossly expensive. And in that sense, they're probably sigh of relief. But yeah, it remains to be seen what they do with this or what happens to this company. Its existence is certainly not a guaranteed. And Pete, like what you said, about getting back to basics. So they announced a plan to essentially restructure the company. CEO stepped down. They want to bring in somebody with more turnaround experience. And just like you said, 31% of the workforce out the door, and they're doing a lot more initiatives to basically save everything they can. Because you look at the financials, and you don't see like a company in massive crisis. But I mean it when I say their future like is not guaranteed. Like they are cutting it close. They basically can't continue to lose money like this, or they will be gone. So they're making the right moves to clean things up. I wonder if they make these moves, and in the time that they're doing this turnaround, let's say, does Amazon come back, or does somebody else come back? Maybe it's at a very different valuation, but I still do feel like an acquisition, being acquired, is the most likely path for this company's survival. I think it needs to get bigger.
I agree that fundamentally, these guys have been around for a long time. I think they got caught up in some really great years and really took up kind of a bad strategy of growth. It wasn't there. They lost kind of the revenue. They probably had some really bad forecasting done, but they got to this size for a reason. People probably, I don't have the product. I looked at it once for my office and thought, whatever. I have a Dyson at home. It's awesome. I would invest in that company if I could. Yeah, it's amazing. But I don't think fundamentally it's bad. I think they had an interesting kind of couple of years. But if they can get back to basics, it probably looks a little undervalued.
Yeah, when I look at this business, I see a moat that is under a lot of pressure right now. As you guys said, again, you look on the Amazon store right now, the Roomba is not even at the top of their flagship product. Beyond that, again, I really think this is a transformational period overall. Again, there's been a lot of hype with AI, and iRobot is a perfect candidate to benefit from that. But the problem is that we are facing problems in a lot of these technologies that we are striving to achieve. And a company that is solely focused on robotics like this needs to have not so much the hardware, because yes, the hardware is important, but it's the software that is ultimately going to set a company apart in this field. And I just don't see, based on capital, based on expertise, or any of that matter, Roomba and iRobot being able to achieve that. So maybe they're acquired for their IP and the data that they do have, but beyond that, I just don't see any value in this business. And other than an acquisition arbitrage opportunity, I would kind of steer clear personally.
I mean, Declan, I wouldn't mind hearing a little bit more on that, because obviously you're well versed on robotics and autonomous. Is there any leverage with something that's autonomous in your house and how that could be leveraged to a car? Or is that just not a data set that kind of overlaps?
Well, I think it's just more the principal foundation of how the software is developed. Again, you can refer back to kind of how we discussed about, say, active inference AI and how that works in opposition to machine learning, deep learning, and neural networks. And I think that's just where the fundamental issue lies, is that, again, you're not going to trust a device to operate completely by itself unless you can have full confidence that it's going to act in a way that is optimal and is not going to put people at risk or behave in a way that, again, just causes any form of risk of that nature. And the problem is, the reason why Apple, Tesla, all these companies that are touting that they're building autonomous vehicles haven't been able to bring a product to market is because you can code a car to, with all the data that Tesla has in the world, you can code it to drive on these roads. It can use GPS technology. It can access the internet. It can do all these things. But the moment, say, a deer runs onto the road, or a person jaywalks, or something unexpected, something random that you can't take into account in the data set as it happens in real time, these products struggle to adapt and respond accordingly to that situation. And we don't need AI to be like humans, but we do need it to act in a way that is going to make decisions similar to how we would respond in those random events. And that's ultimately where something like active inference AI is able to offer a solution that actually remedies this. So that's where I'm saying, if these legacy robotics companies, which pretty much everyone is, continues to focus on machine learning, they're going to be stuck in this loop where they're always running into the same problems, no matter how much data they have, no matter how much computing power they have, until they find a new solution and approach through that software angle. And that's where, again, I just don't see, sure, like a Tesla may be able to adapt and evolve and potentially like embrace this new technology, but a company like iRobot just doesn't have the capital or the team to be able to do such a thing. And so maybe that's where if they do try and adopt, that might be their only saving grace, but that's all I can see from it.
Yeah, fair point.
Yeah, well said.
The only thing I'd say is that iRobot is most likely a company that made a robot vacuum, owned the market for a while, and then may just disappear. But the part that gets me excited is the fact of all this chit chat about spatial computing. We've talked about Versus. Obviously, they were kind of one of the first probably the first public company to even really talk about it, as far as I've made aware, about spatial computing. Apple with its new headset, they refuse to call it virtual reality. They call it spatial computing. Big post, the era of spatial computing is here. So the only thing that makes me really curious about this company, not the only thing, but one of the major things, is what kind of data do they have? Have these little things been cruising around people's homes for the last, 20-something years, 21 years, and collecting massive amounts of data on where everybody lives and what kind of electric appliances they have, and who knows what other data? That could be very significant. You just mapped out homes of millions and millions of people for these spatial computing companies that would love to have that data. So I still think there's some big tech company that swoops in, possibly at the last second. But that's really the only outcome I see. That's really the best outcome I see for these guys. The other is just slash and burn, focus, and hopefully start growing again.
Yeah, I guess. I mean, I love talking about data, guys. Declan, I really enjoyed what you just said there. You're right, machine learning with data sets, all the data in the world, let's say if you were to go autonomous, can only get predictive to a point. You're absolutely right, and that's still what makes us human, and some of these platforms still platforms, right? If it hasn't seen that instant of some of the examples you brought up, like a deer running across, it doesn't necessarily know how to react until it's too late, that you hit deer and you say hitting deer was bad and causing this accident was bad, and it won't do it next time. So that's a pretty significant risk. In terms of what crumbs were on the ground in my house, I don't know, guys. Where do we leverage that? I know we can't talk about this forever, but I'd be curious for us to maybe think about it on our own time about who could value that and why.
We'll come back to this then. iRobot, good luck to you. What are the odds that Amazon just hires all 300 people and creates a competitor in-house? We'll see.
The Bezos special.
Yeah.
The Bezos special. So, iRobot, Amazon, good luck to you both. Yeah. Moving on, Bragg Gaming. Peter, that's over in your neck of the woods. Actually, a downtown Toronto company. They have pivoted over the years, but essentially now their main focus is creating online casino games. And the recent news that we're covering today is that Digitain, someone who's a leading provider of sports books and casino platforms in the industry, they signed a distribution partnership with Bragg. Now, 500 of their quote-unquote thrilling games are going to now be distributed through the Digitain platform. So certainly a good news. I think that's a story that brought this company to our attention. I don't think that's necessarily the story we're going to go crazy into, but I am curious about this company. Declan, Mr. Fundamentals, why don't you kick it off this time? We want to give us some thoughts about Bragg. What do you think of these guys?
Yeah, sounds good. I'm kind of be a Debbie Downer, I guess, this episode here, but my bet really is that this company won't last, and the hype around gambling in general is very short term. First of all, I love how on their website they promote that their business grew at a 60% compound annual growth rate from 2019 to 2021. But my question to Bragg is what happened after that, because it's not looking too pretty. So
can't brag.
Maybe
anymore.
They need an update to the old website. Yeah, no kidding, right? So, but moving on, just anyways, like I look at the gambling market as kind of a bigger reflection of, call it the general nature or general human nature, and as well as just the economy in general. After COVID happened and the pandemic broke out, the U.S. government injected over $3 trillion in cash into the economy, and people were stuck at home. They had nothing to do, and they had some spare change to put to work. And, this went just beyond households, but as well businesses. And what this causes when you have this influx of cash is a increase in irrational behavior, let's say, where you're willing to take on more risk because, again, this cash was free. You didn't have to work for it. It's not part of your livelihood. You just benefited from there being additional capital available. And so what are you going to do? Well, you might gamble it on a online gaming platform. You might buy cryptocurrency. You might buy NFTs. All these different markets, they essentially shot up, including stocks. And it's more just a reflection of how humans behave and the cyclical nature of it all. And, we go from periods of greed to fear and back again all the time. And I really do believe that we're still in a period of greed overall. Again, 2021 was a prime example of it, but then we had a correction in 2022. But I don't really think that cleared out all of, I don't want to say bad actors, but not necessarily businesses that deserve the valuations they have. And we're kind of returning back to that period. And I really just see the gambling market as a product of that overall. So when it comes to Bragg and the business itself, they create online games. They have a ridiculous array, in terms of the number of assets, and how they can really differentiate from the big players. I don't see it. So if things kind of, shit hits the fan and the stock market tumbles or the economy kind of tanks, people pull back the amount that they're willing to spend on these websites. I don't really see Bragg lasting. And, I guess on the bright side, maybe some of these bigger players with a lot of capital could come in and scoop up and potentially consolidate the market overall. But I just don't see it as a good investment.
Yeah. Interesting. In terms of gaming, is gaming viable and is it gambling going to be here forever? And the statement, the house always wins, true? Yeah, for sure. That's happening. I don't know. Declan, have you ever been to Vegas?
You old enough to go to Vegas?
I have, but when I was before I was of age.
How do you think it was built? Off people's lost money, right? So
but I'm sure it's all people
it
who
is
can afford
very
it,
much
right?
viable, is it? Oh yeah, absolutely. So that is interesting you bring that, because I do like doing some sports betting on a couple things, on football, golf, UFC. That's it. The only things I like betting on. Makes it a little bit more fun, stay within my limits, all of that great stuff. Their angle's a little different here. I don't understand the allure of playing a virtual slot machine, but I don't understand the allure of playing any slot machine. So, I think they're a little bit more positioned there, it seems. The content deal that they're done is interesting. I kind of see this. Yeah, it's kind of another recent bubble, though. Gaming in general, right? A lot of these guys who have rushed to the public markets, and someone will eventually own this space. I don't know if this is the player. I don't know. I also think this one, Kev, I don't know if you have a second to pull it up, but this one looked like an RTO as well, which I don't always love. Their history is a lot longer than what gaming is. So
interesting.
Yeah. So I would double check that one.
Worth checking. I know the core of this business was an acquisition of a company called Onyx, so it's perhaps that was the RTO. I can take a look after and dig into that. But I know there was a core acquisition which shaped this business, so that could have been.
I kind of feel like gaming is following some recent bubbles that we've seen in at least Canadian exchanges. We saw it in cannabis. I think cannabis today is as publicly traded market cap is worth far less than before it ever went legal. We saw a big boom in psychedelics, which I think has a much brighter future ahead eventually. And you're kind of seeing it in gaming. You kind of see it in these exciting industries that were once kind of underground and black market coming to life, and we can all make money off of them, and they get hot, but they're only worth so much at the end of the day. So someone's going to come out ahead. I just don't know when, and I don't know if it's these guys, judging by everything I'm seeing.
I've never gambled at all. I've played poker with friends. I played blackjack a couple times at casinos, and I think I've put a grand total of $40 into slot machines. Got absolutely no thrill from it, and decided never to do it again. I do, however, know how addictive these online casino games can, and I actually have close friends who've, without saying much, have gone in very deep on these things. So I know the power of that. Declan, great point about being stuck home in the pandemic and wanted to click some buttons online and trade some stocks and read Reddit. That sounds like the perfect storm. For these guys, their revenue, give them credit, it's grown over the year. So it's a growing business, albeit not at a blistering pace. They've actually got decent margins, like off the top gross margins, like almost 50%. So whatever you think of the business, it's actually a half decent margin. And it's the SG&A pretty much, or no, not pretty much. It eats through all of it and then a little bit some. But though they're a net loss company, it's not a big net loss. It's like a bit over $1 million a month. If you're looking at the recent 3 months, if you look at the last 9 months, it's a little bit less than that. So it's a company where you could see break even, possibly net profit in the future. So I don't think I share the massive doom and gloom that you have of thinking they're going to go out of business, but I think they're going to be cutting it close. Where I do think there is the opportunity is for them to get acquired by somebody. So I believe it's their second largest shareholder on the cap table, wrote a letter to the management pitching them on seeking acquisition opportunities, and gave a lot of comparables of other companies that have been acquired, looking at the multiples. And he basically came to the conclusion that he thinks the stock could be close to 3 times higher than it is now, under a fairly reasonable assumption for an acquisition. And he actually identified a few targets that he think could make the play. So there's kind of your positive catalyst to the upside. Negative catalyst to the downside is that actually is it their largest? Let's see what I wrote in my note. I think it's their largest. It's their largest customer, Bet City, which is Dutch. It was acquired by a London Stock Exchange company called Entain, much larger company. I think their market cap's somewhere 5 billion or so. And within the next couple of years, they're actually going to be eliminating the majority of business going towards Bragg. So they've got this negative, this positive as well. So it's a very unclear stock. One thing that is for sure is that if they're going to keep burning cash, at this rate, their cash isn't going to last a whole lot longer. They aren't exactly flush. So it's uncertain. It's uncertain.
Well, and just to second that, Kev, I think you're spot on in terms of the acquisition, and that's kind of what I was saying with the if it is a down market, it could be in a good market like this, but in the event that a down market happens, they are a perfect acquisition opportunity from that standpoint. And then, to your point about the gross margins and everything, it is a software business. So once the games are built, there's not a lot of maintenance and everything that goes into it behind that thing. My question on that side of it is really why do you need 500 games? I don't know how many of those are concentrated into slots or whatever, but how much of that is your revenue being cannibalized by your own products is kind of one thing that comes to mind there. And then just the last point to make on my end is that, gambling is not going away. The whole market itself, there's a lot of money to be had. And like you said, it is addictive. There's a reason that people go into it. And, if you do it responsibly, it can be a lot of fun. And so there's always going to be a market for it. It's just a matter of, I think, the sign of the times right now and what people think about it. And just to put into context, actually, so I have a friend who started a business on TikTok, and he basically promotes this sports betting affiliate, and I can't remember which one it is, but he made over $100,000 in 1 month just promoting these sports affiliates through TikTok.
Wow.
And so there's clearly a lot of money to be had, and you can take advantage of it. But I just see as a publicly traded business, if I was looking at Bragg, it's really hard for me to consider that as the play I would make in this industry when there's much bigger players like DraftKings, or even who was it that just IPO'd this past week here?
FanDuel?
FanDuel. Yeah, FanDuel. Yeah. So
FanDuel?
They and if you look at FanDuel's financials, they are cash flow positive, they're profitable. They have such a better financial position than a company that like Bragg, where, sure, maybe the valuation, since Bragg is smaller, you could benefit from the upside if they really built a strong business model. But if I was to choose in this market, I would probably pick something that is a lot more secure, because I don't think this hype is going to last. And the question is, that it's the old Warren Buffett saying, like, you only know who's swimming naked when the tide runs out. And I think a lot of these businesses that are benefiting right now, when that time's come, they're going to have their pants down and they're going to be wondering what the heck to do. And hopefully an acquirer comes around and buys up what they can.
Yep, absolutely.
Yeah. I mean, it was tough having this conversation with two guys that don't know the excitement of hitting a 7-way parlay on Sunday, but yeah, this will take our sides. Yeah.
Dang.
Yeah, I mean, it's one of those things at the end of the day, since we're talking about Warren Buffett, is invest in what you understand. I've never put any money into an online casino game. I have no idea what this excitement is. So for me, it would just be uneducated for me to even consider making some kind of investment into this without first becoming a bit of a gambling degenerate. And then, hey, maybe we'll be back. Who knows?
Hey, you invest in penny stocks, don't you?
Touche. I feel like I understand those a lot better than I feel like I like my odds better, but who knows?
Yeah.
But yeah, fair point. Yeah. Okay, enough about online gaming. Final topic of the day today: Paramount Global. If anybody here subscribes to Paramount Plus, I think I did for a total of 2 weeks. Mega acquisition offer coming from Byron Allen. Big media mogul. One of the assets he owned is the Weather Network, among many other things. The deal itself, he approached the company to buy all the equity for about, I think it's about $15 billion. And then there's another 15 or so billion of debt. It's one of those companies with a dual share class. I hate that. One voting, one not. I think that's I hate that. Red flag immediately, but forget it for now. He offered about a 50% premium though. So it's a pretty sizable premium for existing shareholders. Interestingly enough, though the stock moved, it still closed at $14.68. So does this mean people don't think this deal is going to happen? Is it not being taken seriously? Is there something I'm missing? So I'm not sure, because that seems like a pretty attractive offer for a strategic like him. Given that kind of premium, he must see a million synergies. I know he's going to be selling off a lot of the assets. But does the market not think it's going to happen? Pete, what are you thinking?
Yeah, it kind of seems that way. I mean, overall, this industry in general seems like it's something you just don't want to be a part of as an outsider. It's certainly not what it used to be. But yeah, that's kind of the way it's signaling. Declan, what are you thinking?
Yeah, I mean, like, kind of speaking about Warren Buffett, early on in his career, he made a killing on acquisition arbitrages like this. And for the most part, like, as I've kind of observed these opportunities, whether that was like Elon Musk purchasing Twitter, or even like Amazon buying iRobot, or there was the potential merger between Spirit Airlines and JetBlue. There's a lot of recent examples that can kind of help bring some perspective to these opportunities. Now, that being said, I'm actually pretty interested in this deal and really considering whether to make an investment or not.
Really?
This may be only one of the few short-term plays that I would ever make. And short-term meaning anything less than 2 years. As you guys said, from a long-term standpoint, I'm not really sold on the business when it has over $16 billion in debt and its interest payments are at $900 million. I'm not trying to hold this business for the long term, but from an acquisition standpoint, it is quite attractive. Like you said, Kev, there's about a 50% premium to the current market cap. And obviously Byron Allen, sorry if I botched his name, but Byron Allen, sorry. He's well versed in this market and understands probably the value of Paramount better than most of us would. And so with him saying that he's comfortable buying not only the equity position, but all of the debt as well, is a clear indication that he's in it for this business's assets and in the long run. But again, I'm not trying to make this investment from a long-term play. If I'm trying to buy this, I'm trying to bank on this deal going through. And so I think it's important to understand more the risks associated with acquisition arbitrage. For one, and this is a prime example of what happened with Amazon and iRobot, is you could be blocked for antitrust regulation or reasons where they think that, potentially, like even in this instance, this is probably the most likely risk because Allen Group is already a pretty big media conglomerate. They may go ahead, like the regulators may say, hey, this deal is not going through. You'll have too much of a competitive advantage purchasing this business. on top of that, the deal could also be severely delayed like these. So iRobots, I think you mentioned, Kev, was like 18 months or something like that.
18 months.
If this deal goes from, if this deal happens in 1 year, it is very attractive. But if this gets stretched out and it goes over 2, 3, 4 years before it finally comes to fruition, this is a lot less attractive. And that's kind of like, say, what happened with Microsoft and Activision, where it was extended and the attractiveness of this investment becomes a lot less over time. So either way that one last point is that, a business could go under in the meantime before the deal actually happens. I don't really see that happening with Paramount itself. They have a lot of debt, but historically they have been profitable aside from, say, like this most recent trailing 12 months, and they have been growing revenue. They still have ample cash on their balance sheet. And so I don't think they're in a position where they'll face a liquidity or bankruptcy crisis. So that's not a big deal. But regardless, if any of these risks occur, what's probably going to happen is the stock price is going to tank. And that's really like the big risk that you have to understand here is if news doesn't come through that the deal is happening, and especially existing shareholders were banking on it happening, that's going to tank the stock price. So that's kind of the risk that exists with these deals. But that being said, because of the positioning of Paramount, the brand, as well as the assets that it has, I don't see the bankruptcy risk. It could get delayed, and if ultimately like it's blocked for antitrust reasons, like I see that as less of a risk than something. Even I was honestly surprised Microsoft was able to acquire Activision. So comparing it from that standpoint, this is probably the most attractive acquisition arbitrage opportunity I've seen personally, and I'll have to do more digging to really like see, because in the end, if it doesn't go through, I still own those shares. So I either have to decide if I'm going to sell them, or I think there's enough value in the business that it's worth holding on to beyond that period. So, yeah.
This reminds me of, kind of makes me think of our conversation about Dish. Big legacy company. Everybody knows it. They've got this TV business that juices cash flow, but it's, reducing in number of subscribers. Then they have these kind of new age platforms, in this case Paramount Plus, that is growing. It's expensive. It has a lot of similarities to that. And I know with this recent acquisition offer, I couldn't find the article on my desktop here. I had it earlier. I must have closed it. But I think the intention was to sell off a lot of the assets and then really focus in on Paramount Plus. So my guess would be the main reason for that is, well, one, probably gonna have to borrow a lot of money to get this done, so he'll need something to pay it back. But two, I'm guessing that they're anticipating a lot of regulator scrutiny, because in my opinion, I think acquisition arbitrage, hey, Warren, good job for making a lot of money in your day. I think that's just becoming less and less attractive, in the sense you see Amazon and iRobot, that was 18 months and then they terminated it. Intel Tower Semiconductor, 18 months, then they terminated it. Adobe and Figma, 15 months and then they terminated it. I think it's just these regulators have poured a icy cold glass of water on the acquisition space. So that kind of scares me, and I think that may very well be what we're seeing in the share price. People are saying, oh my God, not another one. Like, good luck getting through the regulators. I just don't believe it. So I wonder if that's what's going on. It makes me nervous.
This is also, generally speaking, like media and media conglomerates are actually a lot more heavily scrutinized by regulators. And even though the capitalist in me is really into free market, this is one of the ones where I think regulators should exist, that there should be a little bit of differentiation amongst media, because otherwise you get way too many corporations that have maybe their say on certain narratives. I'm not necessarily talking about just, let's say, Paramount in general. North of the border here in Canada, we see this with the CRTC often, with kind of our two biggest conglomerates, with Bell and Rogers. You'll see them when they're trying to acquire some of the other players. The CRTC says, fine, go sell property X, Y, and Z. So I think, overall media conglomerates are heavily scrutinized when, M&A comes into the space. I think, Kev, what you were saying, and Declan, as a risk of going under, no, because I kind of believe in some of the assets that are here. Banking on Paramount Plus as the way to go is not something I would like hearing if I was a shareholder today, just because the streaming wars are kind of crazy overall. Paramount Plus was actually the one where I drew the line on subscriptions. My wife wanted to get it, for one show. And I was like, no, we're not doing it. I have too many of these. I got Netflix, HBO Max, some other ones. And I was like, this is just the one that we do not need. So I was willing to draw the line at $9.99 a month and just not do it.
Yeah, I think I had Paramount for a couple weeks. I watched, what was it? It's the Halo series, which I had such high expectations for, and it was like not that good. And if you look at the
Yellowstone,
was it a flop? Yellowstone.
Yellowstone too.
So, I mean, there are some name brand titles. They've got some good IP. If you look at the slide deck, it's very skewed towards Paramount Plus. Like, it's very, very clear that they're putting their hope on Paramount Plus being the salvation. And they talk about how there's room to raise the prices a bit. I think they showed their comparison. Obviously, Netflix has actually gotten fairly expensive compared to what it used to be. So they say there's room for them to move their prices upwards. So for organic growth in their average revenue per user, I mean, I'm just not buying it. Like, the catalog is just not that great. And like, it's just like, out of the three of us, okay, Pete, we know you don't have it. I don't have it. Declan, do you have it?
No.
Okay. Do you guys have Disney Plus? No? Terrible example. I did.
That was the one I did cut recently because they have ESPN and they have a lot of sports docs and all of that. Yeah. But then I didn't watch it for like almost a year, and I was like, okay, I get rid of it.
So there's like a half Netflix. I'm assuming we all have Netflix. So
Netflix, yeah.
I wouldn't be surprised if we surveyed more people that Paramount's probably one of the afterthoughts for everyone. So betting the whole farm on that, I don't think the catalog's good enough as it is, but I mean, we'll see.
Yeah. No, and that's demand. It really is. It's again, looking at it from this lens, I don't see this as a long-term play. Within that market itself, it is not a top player, like you said, and it's really, you're essentially betting on the acquisition going through, and where those odds lie is kind of where this opportunity presents itself. But again, for it to look really attractive, you want to be sure, at least on the downside, that you don't lose a lot of money. I use the example of Twitter, where I think if it came to light and they were still a public company right now, things would really be manifesting and their valuation would be significantly lower than it is. And even Elon Musk has admitted that he overpaid for the business. But fortunately for those people that decided to kind of bank on Musk buying the business, that they obviously benefited from that price appreciation. And so that's where there's always a risk. But if you're going to take these chances in merger acquisitions, merger acquisition arbitrages, then you want to be sure that at least on the downside, you're not going to be screwed heavily, because in the end, when it's announced that it doesn't go through, that stock price is going to drop, and by how much depends really on the fundamentals of that business.
So,
well, Declan, you've piqued my interest. The fact that you're looking into this is certainly making me more curious.
Might have to take a bit of a deeper look of Mr. Longhold over here looking at a short swing trade.
Like, short, is there
2 years? 2 years.
That's right.
Like, is this maybe a buy the rumor, sell the news kind of thing? Like, maybe we have one acquisition in. I'm sure there's a lot of people who would want the pieces of Paramount. I know they said, I keep seeing this name Ellison, and I can only assume it means Larry Ellison. I don't know if he's in the media business or if he wants to be, but there is definitely other people interested in this. So could a formal acquisition offer bring in other people to the table? Do we get a little bit of mystery and news? Maybe there is a share price pop and we're out of there before it gets too far along. That's something worth considering.
Yeah, no doubt. And it, just like one final point on it too. I think when I've looked at previous examples, one thing that surprised me about this too is just the lack of a reaction. A lot of the time when you see these announcements happen, again, the stock price shoots up and you're already like, well, there's not much of a window to even like benefit from this. It's really close. But the thing is that this one, there's a minor jump, but overall, like, it's still at about a 50% premium to the valuation that Byron has proposed compared to what the current market cap is. And so for that reason, again, it just makes it more attractive. Now, again, you got to understand the risk and everything, but because of that potential and that lack of reaction, it makes it more attractive than something that after you hear the news, you see it shoot up 20% and you're like, oh, great. Well, there goes my chance. In hindsight, why didn't I anticipate this before it happened? So that's kind of where I'm at.
Fortunately, stocks only go up, so there actually is no risk. So that,
of course, yeah.
So you should be reassured.
Yeah.
I don't have any further thoughts on Paramount. I still don't intend to subscribe, though I will be watching the stock price as my entertainment.
Yeah. Likewise.
Okay, boys, this was a big episode. We covered a lot of ground here. I had fun with this. Viewers watching, if you've made it this far, you are truly true blue to the Edge brand. Thank you. A like would go a long way, and subscribe and share if you haven't already. This is Small Cap Kev, Trend Tracker, Mr. Fundamentals, Beyond the Edge, Episode 8, and we are out.